Welcome to Discovery Watch with John Kaiser.
I'm your host, Jim Goddard. We're speaking with John Kaiser, and we're doing a little wrap-up for the end of the year about the natural resource industry and the kind of things that you're finding out that you think could happen or might happen and what has happened over the past year. So, John, if we were to witness a global geopolitical crisis that disrupts global trade, which metals would be affected from the North American perspective?
Well, Jim, China's a dominant supplier of a lot of metals. I mean, we're familiar with the rare earths, of which they still represent 95% of all supply. And we saw what happened in 2009 to 2011 when they started playing games with the export quotas and restricting supply to places like Japan. Tungsten is another important metal. It's both important for the war economy as well as the real economy with its role in tools, and most of that comes from China. Antimony is another more boring metal. 85% of that comes from China. It's used mainly in fire retardant applications when it's time to reshore all the manufacturing to the United States and create big giant tariff barriers. They're going to have to make an exception for antimony coming from China unless that stibnite mine of Midas Gold gets fast-tracked into production and starts producing stibnite as a byproduct. In fact, during World War II, the stibnite mine was America's primary source of antimony for its war effort. But other metals such as, say, zinc, of which China provides 40% for the world. China is in fact a net importer right now, so there wouldn't be any zinc coming from China anyways because China's mopping up all the zinc. In fact, zinc warehouse stocks, both Shanghai and LME, are like really down, almost as bad as they were in 2006-07 period when they got extremely low. So China would be mopping up zinc from other parts of the world. So we could see if there's a problem where stuff is not moving around, zinc that's closer to China would ship to China, and that might cause the price to rise in other parts of the world. But that's kind of like a global scale geopolitical crisis arising from the trade war and the American, which is now also a global desire to have China back off with its technology theft, and that this is a conflict over which tensions have risen, which I do not know how they can be easily diffused. Another metal that could surprisingly be affected is nickel. Right now, the big bane in the nickel market is the Philippines, where they mine these low-grade laterite nickel ores and ship them as whole ore to China, which feeds them into their nickel pig iron furnaces. And Indonesia was also even bigger than the Philippines until they imposed a moratorium, but they're moving back to starting to process onshore these nickel laterite ores for the nickel pig iron market. So if a geopolitical conflict erupts in this part of Southeast Asia, where suddenly the United States and its allies, insofar as there still are any, cannot really move goods around, that would take nickel off the world market. And of course, Russia, through Norilsk, is a major supplier of nickel, and it's also a major supplier of palladium. And palladium has completely reversed its price relationship to platinum. Platinum's around just under $800, but palladium's about $12.50, $12.60. In fact, it was higher than gold recently. And the shift in palladium and platinum is due to the fallout from the diesel scandal that Volkswagen created a couple of years ago. There's a shift away from diesel for ordinary consumer vehicles to gasoline, and the catalytic converters for diesel rely more on platinum than palladium, whereas gasoline based catalytic converters rely on palladium. So we're seeing a spike in palladium, and Norilsk is scrambling to increase its palladium output, but that will take a couple years. But if there is a conflict with Russia and the West, that could shut down the supply of nickel and palladium from Norilsk, which would create a serious problem because South Africa is primarily a platinum producer because the platinum grade tends to be higher than the palladium grade in their Bushveld reef deposits, whereas elsewhere in the world, palladium tends to be higher grade than platinum. So we could actually see a revival of interest in these ultramafic complexes that have nickel, platinum, palladium in it. So those are just a few obvious examples that would be affected. If Brazil, for whatever reason, decided to become a berserk place, the niobium, which 85% of the world's, $2 to $3 billion worth of it, which it consumes, comes from one deposit, Arasha. That would suddenly disappear, and that would be a big problem for the steel making industry. And of course, cobalt. 65% of all the cobalt comes from the Congo, and a lot of it, more of it, could come from Congo also. But the country seems to be lurching towards a disaster. We have an Ebola outbreak, which isn't really a geopolitical conflict, but we also have the election problem where Kabila just doesn't want to go, and warehouses storing election machines mysteriously catch fire. So Congo, sort of local geopolitical disruption of supply, could put cobalt back into vogue. So that's a couple examples of metals that would be impacted by a geopolitical conflict.
How do things stand with the car battery metals, cobalt, lithium, and graphite that were hot in 2017?
Well, lithium carbonate has dropped from being sort of $12, $13 a pound to as low as $5 a pound. The supply shortages that were created by the fact that there were all these salars in Chile that had quotas, and you could only produce so much lithium, and it was dominated by a handful of companies. This potential shortage for the lithium-ion battery application seems to have been fixed both by Chile expanding its quotas, allowing the big guys to produce more lithium carbonate, but also the search for pegmatite deposits, bedrock deposits, especially in Australia. That has been very successful. The hype about the electric car really attracted a lot of capital. So I think the lithium supply problem has been largely solved. Graphite, most of the flake graphite still comes from China. So this is another material that would be affected by geopolitical conflict. But there's many sources of graphite that can be mobilized, and there's lots of projects at various stages. Vanadium is interesting in that the flow batteries used for long-term storage of power from intermittent sources such as solar and wind, this has been a huge challenge for that sector. And the vanadium battery seems to be emerging as the winner for this. And vanadium went from being sort of $6 to $8 a pound a couple of years ago to as high as $60 a pound this year, an exponential chart similar to what cobalt did last year. And it's fallen back to $40 a pound. People like Mark Smith from Largo, which operates a vanadium mine in Brazil, has said we don't really need vanadium this high. This encourages too much new supply to come on stream. The historical suppliers of vanadium have been China, South Africa, and Russia. And in our geopolitical context earlier, again, if there is a disruption of trade with Russia and China, that would certainly impact vanadium supply. And South Africa has its own domestic problem that it is contending with. In terms of the sort of electric car vehicle hype and battery materials, it does seem to have died down. We had a fairly subdued year. Cobalt sort of topped at $42 a pound and is now back to $30 per pound. Many of these nickel cobalt projects, laterite projects in Australia, they have stalled. Nickel has sunk back to sort of $5 a pound, and so nickel's of course also a battery type of material, but the type of nickel you get from those low grade laterites in the Philippines and Indonesians, that gets fed directly to make into furnaces to make stainless steel. So that is not a source of the sort of high grade battery or battery grade nickel needed for these batteries. So in terms of the car battery metals, it is considerably subdued. Cobalt is still an issue because of the instability of Congo. Vanadium, I think, is strong because we have these new long-term storage battery demand growing, and we've seen the cost of wind and solar energy come way down with the cheaper costs. And despite efforts to revive coal combustion as a source of energy, the trend is really against that, and American taxpayers really don't want to subsidize inefficient, expensive, dirty coal plants in the United States.
We'll have more with John Kaiser right after this.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Welcome back. We're speaking with John Kaiser. John, was there anything new on the scandium front?
2018 was a very slow year for scandium. The lead company, Scandium International Mining Corp., which had obtained its mining lease and consolidated ownership 100% in 2017, it changed its strategy for raising the $100 million or so needed to build a facility that will produce 35 to 40 tons of scandium oxide a year. And what had become apparent was that the big obvious potential users, such as the airline industry, their need was way too far down the road. They had a backlog of planes already sold for which the existing blueprints worked. They would have a certification cycle. The car industry was more obsessed with developing electric cars than thinking about the lightweighting issue. And the basic problem for a primary scandium mine is that if you build it, the hope is that they will come. And that can be a gamble made by the people who put up the capex. But what happens with the end users is once they see that you've built it, risking your own nickel, they just can stand back and wait for you to suffer. And if you want to stockpile the scandium, well, then you have this problem that you have to fund the operating cost of mining and extracting the scandium oxide and stockpiling it enough to attract bigger users. And no individual company off-taker wanted to commit to taking, say, all of the 35 tons because they would need to tool up ahead of that. But every new type of mine where a particular element is being produced as the primary element for the first time ever has a risk that when it goes into production, it may not perform as expected. So the end users who would have tool-up costs and pre-marketing costs to make sure that the products into which they incorporate scandium can be sold, they're exposed to things going wrong at the plant level. So in the case of Scandium International, they decided, well, we're going to move downstream. We're going to start making master aluminum scandium alloy. We're going to go after many, many different individual off-takers, do deals with them, letters of intent where we send them material that they can experiment with, play with, understand what it would be good for, and maybe end up with a dozen, maybe even 24 relatively small off-take commitments, 2 to 4 tons per year, none of which is going to put any of those companies at risk. And this, of course, is a slow, painstaking process. They only started it at the beginning of 2018. Our market reacted negatively to it, and the stock sold off when they realized that CapEx was not going to be funded. But they feel now we need to have the order book full before we go after CapEx, and all those groups will have the potential to increase their demand many times over. So they would have actually put in place the scale-up. If the Ningbo plant works properly as expected, they can then double production from cash flow, even quadruple production. And all the other scandium companies who are a little bit behind in terms of completing their definitive feasibility studies, they've all taken their cue. In the case of Cleantech, which delivered a DFS for its Sunrise project in New South Wales, which is primarily cobalt nickel with a scandium byproduct, they decided to stockpile the scandium in another form and wait for the market to develop, because of course their scale of production is geared towards the nickel cobalt output, the whole battery market. Platina just completed a definitive feasibility study. Unfortunately, its description is under the JORC, the Australian reporting system, which works fine for reporting resources, but is completely hostile towards investors in terms of reporting details about economic studies. There's no cash flow models. Even Cleantech, which is listed on the TSX and required to file a 43-101 report, managed to get around the requirement to include a cash flow model for each year in the life of the mine, which includes the ore schedule and all the cost assumptions. It simply left a blank in that space, and the regulators, well, they don't seem to have a problem with that omission when it comes from a very big, substantial company. Smaller companies would have to do that, but in Australia, you don't have to provide that granularity of disclosure to the audience. Platina itself is sort of now playing with master aluminum alloy, but generally everybody has realized that we need to develop these offtake markets. These other ones do not yet have their mining leases. They're watching very closely to see how Scandium International succeeds with its strategy. And if Scandium International does succeed, it opens up demand from many, many corners. And SCY itself will be unable to fulfill that demand over the next 5 to 7 years. So Scandium had a bit of a stalled year, and all eyes are now watching to see if George Putnam can deliver offtake deals which convince the CapEx people to put up the $100 million and start building the world's first primary scalable scandium mine. And that will really provide a lift to all the other ones, such as Platina, trying to develop their own primary scandium mines.
How has the diamond sector played out over the year?
The diamond sector, one of the big sort of clouds hanging over the junior diamond sector has been the Peregrine Diamonds and its Chidliak discovery, which for the past 3 or 4 years has been funding itself through rights offerings that were always seemed to be cheaper than the previous one, and the stock price would never really recover. It was being winched down. And Chidliak is the most interesting diamond discovery in the past decade. It was made in 2008 grassroots effort. And in fact, the key people behind that have been awarded the Bill Dennis Award for discovery that will be awarded at the PDAC. Eric Friedland, Brooke Clements, and others in the team for pushing this from grassroots using really good professional techniques to advance this. They produced an updated PEA early last year, which implied evaluation several times what the market seemed willing to assign. And this story ended in July when Peregrine agreed to be acquired by De Beers for about $114 million or so cash. And the irony is that $100 million went into this project to bring it to this stage, to deliver a fundamental asset, and De Beers essentially paid a $14 million premium to own what will probably end up being a much bigger diamond mining camp than currently envisioned, because I believe there's lots of potential for some of these pipes, that the 70-plus pipes they discovered in this area, to have a diamond content that is not yet quite understood. This was also an important year for diamonds in that this problem that's been nagging at it, namely the creation of synthetic gems, not synthetic industrial diamonds. That's a problem long gone and dealt with, but the creation of synthetic diamonds through methods such as chemical vapor deposition. This was threatening to destroy the diamond market, and De Beers did a brilliant move where it actually went into the business of manufacturing synthetic diamonds. And in terms of their composition, there's no difference between a natural diamond and a synthetic diamond. But in terms of their mystique, the fact that one's billions of years old and survived this long stay in the keel of a craton, and then didn't get turned back into graphite during the ascent, and then managed to be concentrated enough to be found and mined by humans, that was in danger of all being absorbed into, like, oh, this is just a bit of crystallized carbon. But by De Beers going into the business of producing these and selling them as such, clearly branded as such, and basically creating a demarcation between natural diamonds and synthetic diamonds, they have helped save the natural diamond from just fading away into a crass, easily reproduced consumer product that nobody really cares about because it's just another piece of cosmetic jewelry. The junior diamond sector has suffered during this whole period. The fact that Chidliak had such a low valuation before taken out was a bit of a low point for the sector. But there are other juniors out there looking to find new pipes fields. There's North Arrow Minerals, which is still plugging along in northern Canada. And then there's LithoQuest, which is Bruce Counts' deal, which is revisiting the Northern Territory of Australia. So hopefully we get a bit of a turnaround in the diamond sector. Altius is in the process of spinning out its Adia project, its Lynx project in Manitoba, where it has found a very old apparent kimberlite, very, very large tonnage, do not yet know the macro grade. But it's in Manitoba where nothing really has been found. There's interest perking up in the Western Superior Craton. Private groups are looking at work that was done there in the past and thinking, maybe the exploration approach was not right. So we'll have to stay tuned. In Botswana, Tsadilo, did its bulk sample. The grade came in lower than one hoped for in that sort of 8 to 10 CPHT. Lucara has retreated sharply this year because they are now running out of the open pitable ore and will have to go underground, and it's not entirely clear how profitable that will be relative to finding those Type 2A diamonds at surface. So not a great year for diamonds, but hopefully we are at a turning point for diamond exploration.
We'll have more with John Kaiser right after this.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Welcome back. We're chatting with John Kaiser. John, Novo was the big story last year. Where does it stand today?
Well, Novo also turned out to be a big disappointment after all the high expectations in the second half of last year. What stopped Novo in its tracks was that the measurement problem for these large diamonds, half inch to an inch, big flattish, not diamonds, nuggets, gold nuggets, in this conglomerate, in the Pilbara. They first tried with, sort of 300 to 500 kilo samples last year, figured out that wouldn't work. Then they moved to sort of 5 to 7 ton samples, and on the Comet Well project this year, but concluded that this did not give reliable results. And I said, we really do need to go into sort of large-scale trial mining where we get like 10,000 tons from a particular area, process it, measure it, start to understand what are the patterns where economic grades of these nuggets show up within this conglomerate, because it's not consistent. It's not the same frequency of nuggets everywhere. In a sense, it's similar to a diamond deposit, but also dissimilar. A diamond deposit has a kimberlite has a sort of a log normal distribution of size of diamonds within a mixed magmatic unit. It's different when you get an alluvial type of deposit where a kimberlite erodes and there is sorting and larger diamonds end up in different places from the smaller diamonds. In the case of these conglomerate units, it's a very sort of immature, early stage type of sorting that took place. The clasps are quite large. In fact, some of these boulders in the Comet Well conglomerate were over a meter wide, and so it's going to be unpredictable, or at least not predictable from small scale sampling, where the nuggets ended up. And then, of course, there's local disruptions, local faulting. Sometimes the unit's higher, sometimes thicker. It isn't the nuggets were sometimes showing up at the bottom of the conglomerate unit. So it became a nightmare to put together resource estimate. And this is the problem for Novo and all the other juniors in the Pilbara with their conglomerate units. It's now apparent that these nuggets are all over the place within this conglomerate unit that sits between the 3 billion-year-old basement and the 2.8 billion-year-old Mount Rowe basalt. But nobody knows how to measure where the concentration is high enough. And in Australia, to get to a level of trial mining on the scale envisioned by Novo, you need to have a mining lease of sorts, for which you need a JORC resource estimate. But the whole point of the disappointment was that with this small-scale sampling, we cannot produce a resource estimate. If we want a resource estimate to justify building very large-scale processing of these conglomerate units, we're going to have to go up to this trial mining level. So it's a bit of a catch-22, and the regulators there are going to have to sort this out and come to a conclusion that the work done so far does constitute sufficient evidence of economic potential to justify granting of this lease that allows this larger scale processing to take place. And we don't know how long this will take to resolve. But the company has shifted its attention to another area to the east of where it's done all the sampling work, the Agena area. They paid a pretty penny earlier in the year to acquire this. And this is an area where the conglomerate unit has already been eroded and washed into marine terraces. The big boulders have ended up elsewhere. Gravels have been created. This is more like the alluvial diamond deposits that you will find in South Africa. And so there are established methods for measuring the content of heavy minerals. Diamond is actually a heavy mineral, not as heavy as gold, of course, but to figure out where they ended up in these marine terraces. And Novo has collected a whole bunch of samples for which it is awaiting results. And this you could actually start mining because it would be a placer type operation, not a blasting of bedrock and crushing and so on. You could start mining this a lot sooner. So this is the sort of new shift in Novo's strategy. While it bides its time waiting for the permission to sample the conglomerate unit on a larger scale, let's go in here and look at the leftovers from these conglomerate units where all the breaking apart and sorting has already been done by Mother Nature, and demonstrate cash flow, and also demonstrate that, yes, this stuff is all over the place, because there are still doubters out there who think that this is anything but some local, patchy, anomalous type of thing. So for the other juniors, they're kind of just like as we saw in the scandium thing, they're all now kind of in this waiting mode. They cannot get a strong valuation because Novo has not yet validated that the stuff does concentrate high enough in large enough bodies to justify commercial mining. They are now waiting for Novo to accomplish this. What they can do in the meantime is map their conglomerate units, collect anecdotal evidence that nuggets have spilled out locally from these, and get themselves set for the day when Novo has demonstrated or has the trial mining in place and is demonstrating that, yes, the grades of these units in places that are identifiable in advance average a grade that can be commercially mined. And of course, with the Agena strategy of mining these marine deposit terraces, the companies to be watching for are the ones that have what I call the edge of the wedge, where the conglomerate unit outcrops and there is gravel material available in the vicinity where a similar strategy could be deployed once Novo demonstrates that, yes, you can profitably mine these nugget-enriched marine terraces.
What was the biggest surprise this year among the juniors?
The biggest surprise, I would say, at least from my perspective, was watching little juniors such as West Haven Ventures, after toiling for 6 years, going public in 2011, looking for these gold, silver, low sulfidation epithermal deposits in the Spence's bridge belt of southern British Columbia, where for a decade prior others had looked and never quite found what was going on there. And all of a sudden, all this persistence pays off with the help of bringing in expert Peter Fischel on the Kupel deposit and sort of starting to recognize alteration zones and saying this south zone it's different from what we've been looking at elsewhere, and then pulling a couple very high grade holes. And this to me is really interesting because southern British Columbia has been dismissed as sort of this land of smallish, not very interesting gold deposits, and coming up with high-grade, thick intervals. It's not yet established that we do have a mineable resource, but we have seen the grades show up, the thicknesses. They have reported results from some recent step-out drilling and down-dip drilling, which tell us, well, the structure's here, it's not there, so obviously it's not going to be as simple as drilling off a nice tabular vein. We are awaiting assays. Lots of groups have been wanting to finance that. The stock has been running higher in the last in the last couple days. In fact, right now it's trading at $30.31. I don't think this is a case of assays already being in hand. You can look at the visuals and know that those are probably going to be good, but it is likely that a financing deal has been done with some group that will allow this shovel nose project to be properly delineated in 2019. And somebody out there realizing, okay, I'm not part of this financing, so I'm not going to get any paper by standing in line for this, and they're out there groping in the market. So that was a very delightful surprise. There were other negative surprises, but I don't really want to talk about those. I think 2019 is going to be a year of lots of pleasant surprises. We saw Sun Metals with its project, the Stardust, drill a whole bunch of holes that were not really very interesting, but drilling one breakthrough hole that hit a part of the project that had never been hit before, and coming with the best grades yet. This has just been funded with a $5 million charity swap financing, which very interesting development. Tech showed up with a 12 million share position. That's interesting that a major would take an equity stake in this emerging story. I think that's going to be a big story next year. And another pleasant one has been the Nevada Exploration Inc. with its blind target at South Grass Valley, supported only by gold and groundwater anomaly with Carlin-type pathfinders, drilling the first 6 holes and demonstrating that, yes, here is a lower plate carbonate window, clearly pumped, hydrothermally pumped, all the pathfinders everywhere, a low enough gold grade everywhere to indicate gold was part of the fluid flow, and it's the beginning of a new exploration strategy heading into 2019 to go in there, vector in, find could be a dozen Cortez Hills squirreled away in different locations within this system, finding these new types of targets in Nevada, a place that's seen a lot of exploration, where the only discoveries being made are sort of near existing mines controlled by the likes of Newmont and Barrick. I think that was one of the more pleasant surprises. It's a subtle surprise because it's not yet a gold discovery, but it may end up showing the way for renewed interest in Nevada. And I think West Haven's discovery in southern BC is going to ignite greater interest in southern BC. Northern BC with the Golden Triangle has dominated much of the attention the last few years, but it has that awful seasonal limitation where everything shuts down for 6 months, whereas southern BC is much more accessible, just as Nevada is reasonably accessible and relatively low cost for getting exploration done. These are a couple of good surprises that I think will pay off well in 2019.
What is your resource junior strategy heading into the new year?
Well, I have lowered the price of my service from $800 a year up front to $450 a year, acknowledging that we are now heading into the 8th year of a bear market famine that began for the resource juniors in 2011. I am optimistic that we will see gold driving an uptrend that will bring audiences back, but it's going to be a tough slog bringing investors back to the resource sector. There is an age problem. Young people are unfamiliar with this idea of gambling on exploration results. It does require a fair amount of accumulated geological knowledge to understand whether news is good or bad. And so I've refocused my whole Kaiser research online to be of much greater assistance in outlining what is the potential here, what is the size of the prize, is the company doing something that makes sense, is the speculative value good, fair, or is this stock so well promoted that it's poor value? And what about all the zombies out there, companies that if you don't look at the balance sheet, you don't know that they're indebted to somebody or other, and nobody's going to give them fresh money to pay off old creditors. These are like companies still limping along as zombies. And then there's a whole bunch that are what you call fake companies, lifestyle-type companies, where the project just doesn't have anything interesting about it that it might deliver no matter how much money you throw at it. And so I've set up Kaiser Research Online to identify this whole spectrum, one fee for everybody. And of course I'm going to focus on the ones where I think there is potential. And these are also going to be companies that we talk about in Discovery Watch. We're going to track all these emerging discoveries, even the ones that I completely miss and they suddenly break out of nowhere. For example, West Haven, I barely even knew the company existed, and all of a sudden there it is at $1 and potentially heading substantially higher. We're going to be on the lookout for these. We're going to jump onto them as we jumped onto the Royal Nickel story in Australia. I think that's one that's in a bit of a pause right now, and it caught everybody by surprise. It's not on the scale of the Pilbara story, where we're talking about 1 billion ounces being scattered over a 400-kilometer area in one sort of 3 to 10 meter thick conglomerate unit. We're talking about extremely high grade, focused type of deposit at the Royal Nickel project. And we're going to look at these, and out of this, I think in 2019, helped along by a gold uptrend, we're going to see a revival of interest in the resource sector. Discovery exploration benefits from a stronger gold price, and of course the optionality plays. They're essentially involved drilling off these systems, seeing what their limits are, finding out what the different cutoff grades. And if the capital comes in to fund this because people are becoming optimistic about a higher real gold price dragging these marginal deposits into the money, then you end up with something like what happened with Penasquito, where what was originally just a sort of a boring silver project, that when they got the capital to start drilling deeper, discovered that there was a dimension to it which was substantially better than previously understood. So I'm thinking that in 2019, we enter a turning point. The glass starts to shift to half full. It's not going to happen overnight. It has been too severe a downtrend since 2011, and that's actually a good thing, because you have to be a bit crazy to be at the turning point to think it's happening, because it really isn't a turning point except when you look at it in the rear view mirror. But even when this turning is underway, not everything will have moved right away. So there will be plenty of opportunity for those who are just watching from a distance to start paying closer attention. And I'm geared up completely to do that. And with our free Discovery Watch service, we're going to make this story available to unlimited audiences.
John, all the best in the new year.
Yes, Jim, to you too and to everybody else.
We've been speaking with John Kaiser, his website, kaiserresearch.com. I'm Jim Goddard. Best of the season.
Comments made on Discovery Watch are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Discovery Watch is a production of How Street Media Incorporated.